Monday. This is Jay Brew, co-chairman of Seifried and Brew. We appreciate the responses that we've gotten to last week's webcast with Dr. Ed and myself discussing the great exit, as well as the article that we put together, which is available on our website. The thing that many bankers have said is that they've taken these webcasts and actually projected them both in the boardroom and for ALCO. And I think that it's important with this particular webcast from last week that one should have the open discussion with the directors and senior management team in terms of what kind of impact this will have. And I think that the webcast leads into really looking at the overall effect of what a great exit might look like. Within that, of course, we talked about the fact of being able to simulate these different interest rate environments. We talked about headwinds and tailwinds. Well, certainly when we look at it is that it's very unclear as to when the Fed might start a great exit. But since we broadcast, what you've heard from different Fed presidents is you've heard the word inflation. You've heard the thing is that we need to be doing this sooner than later. And when we look at it is that then we have those overall tailwinds. And just as a reminder, what we want to post you on is where Brent North Sea is in here, hitting 124, close to 124.5 in here today, up from being in that 114 type area last week. And where did it get to back when the economy was running into trouble? And as you can see from this, it's in that 144 zone. So if we have another 2 weeks of these increases, we could be very close to the high that was reached before. And I think that that becomes, for Main Street America, a very serious headwind in here in terms of having to cut back spending because we still see those prices rising at the pump. And within that is that could that be the overall headwind that slows this economy back down and keeps the Fed from reacting? Of course, when you look at the fact, and it's somewhat a dichotomy in here with the fact that the Dow heading back up into that 12,400 area, as if none of this is going to have an effect. Along with it is that the stimulus of QE2 continuing to push people into other markets, maybe even some degree sparking the overall what could be considered a bubble when Brent reached that 144 area previously. That could it be that it'll move up even higher? Because you had people talking back then, if you remember, that Brent could head up to 175. That Brent could head up to 200. Talking to Dr. Ed this morning, he feels that with the fact that it doesn't appear that there's really that much of supply interruptions, that he still feels that 200 is most unlikely in here right now. But on the other side is that what will the speculators do? What did they do back in that 2008 period? And then we can look at it from another chart, adding into this GDP. Now granted, there were many other things that went on, as we all remember, the financial crisis, etc. But the point is that those escalating gasoline prices and prices for energy in general did not overall help the markets during that time period, but added into the slowdown in the economy. So we want to have serious discussion about this in terms of what impact that could have on overall interest rates. So as we said, is that we want to look at things, well, if they sort of remain the same in here. Because one of the chief problems that most community banks are running into, and they really have to be able to quantify this, is their asset yields running off not being able to replace those asset yields with the investment yields where they are, or from the standpoint where the loan yields are out there. The next question would be that from the standpoint of course, deposit rates and the fact that many banks are hitting up against their lows in deposits, that they're not going to be able to get the pricing that they've been able to get over the last year and a half. So when we look at that, is that what are we going to do? What are we going to do to plan? For instance, one of our clients came in and said, hey, I think that we could really be doing more 7-year and 10-year loans. Well, intuitively, especially with the 10-year heading up close to that 360 level in here, is that and with the fear of inflation and the bond markets reacting appropriately for future inflation thoughts, is that essentially you'd think intuitively that that wouldn't make sense. Yet the thing is that at a time like this, when just simply keeping the loan portfolio balances even in here is a real challenge. People paying down debt, the continuation, of course, of just regular principal payments in the loan portfolio, make it a very difficult situation. And especially because we're hearing out there that a number of competitors that had been sidelined with loan problems are coming in saying, now we want to put loans on, driving the competition to lower rates, changing terms, and hopefully not increasing the overall risk element of their loan portfolios. So if this continues in the static environment, is that this will become a growing problem. So if we have the flexibility in the balance sheet to be able to add longer term loans, we want to be able to quantify through our modeling the overall effect of that. And then of course, if the tailwinds essentially keep this economy in a recovery mode and the Fed starts to go into a great exit program, which most likely, as we feel, is going to include an increase in rates, that we could see both short rates and long-term rates rising. Well, let's be able to model that and sit there and say, well, what risks would we really have? And an important piece of that, because one of the things that we showed last week is that one of Plauser's simulations of the great exit was an 18-month tightening. Within that, one must not only be able to look at the effect of 1 year, but one really now needs to look at even 2 years and what the overall effect is, not just in the current year with interest rates rising, but also the impact of the second year. And then to sit there and say, well, what do we do, and to be able to model that effectively. And I think that then that starts to answer a lot of questions in terms of what do we need to do to balance our risk, protect our earnings, protect our capital in here to be able to sustain a great exit. This is Jay Brew, co-chairman of Seifried and Brew. Have a great week.